Decoding IFRS 3, a cosmic view of business mergers. Imagine companies like celestial bodies in the vast cosmos. Sometimes these entities draw closer and merge. IFRS 3 guides this intricate dance. It is a financial map for these new business galaxies forming. Its full name is International Financial Reporting Standard 3. It aims to bring profound understanding, especially when businesses decide to combine. This standard seeks financial truth to be precise and clear. Clarity is its most cherished goal. Reliability stands as its solemn promise. Comparability is its invaluable gift across all types of industries. Think of IFRS 3 as a universal translator for complex financial events, specifically for what we call business combinations. This happens when one company buys another or when two firms merge. IFRS 3 works to explain this process using a common, understandable language, so that everyone, everywhere comprehends the newly formed financial picture clearly. This standard is therefore utterly vital. It helps us all to truly see what actually transpires within a company. During these significant, transformative changes, there should be no more hidden figures, just a clear, unobstructed, luminous view of the newly combined business entity, its valuable assets, its binding debts, and its exciting future potential explored. IFRS 3 ensures transparency and understanding, making the complex world of mergers and acquisitions clearer for all. Why does IFRS 3 hold such importance? It champions transparency in financial reporting. It also ensures comparability between companies. Imagine looking at the night sky with different miscalibrated telescopes, each looking at the same distant galaxy. This made true comparisons very hard. Understanding the real financial picture was difficult. Investors were navigating in a fog. IFRS 3 brings a much-needed change. It introduces a standardized, consistent approach. This is like giving everyone a powerful, clear lens, a new window to the financial universe. Suddenly, the images become sharper, the details emerge from the shadows. Stakeholders, like investors and creditors, benefit. They can make more informed decisions, they can trust the information presented. This builds a healthier economic environment. The universe of business is complex. Mergers and acquisitions are significant events. They reshape companies and industries. Without IFRS 3, chaos could reign. Each company might tell its story differently, making it impossible to judge performance or to assess the value created. IFRS 3 ensures clarity and trust in financial reporting. That is the true power of IFRS 3. Let us explore the core components of IFRS 3. First, we must define a business combination. This is more than just buying some assets. It is acquiring an integrated set of activities, and also the assets managed with them. These must be capable of providing a return to investors or other owners. Think of it like acquiring a functioning ecosystem, not just a collection of random stardust. A business has inputs, processes, and outputs. Next, IFRS 3 mandates the acquisition method. This was formerly known as the purchase method. It is the only method permitted now. This method involves several key steps. First, identify the true acquirer, the entity that gains control. Then, determine the acquisition date precisely. This is the moment control actually passes, like the exact moment a star ignites. These initial steps are crucial for accuracy. Once the acquirer and date are set, the next step is recognition and measurement. The acquirer must recognize identifiable assets acquired. It must also recognize liabilities assumed and any non-controlling interest in the acquiree. IFRS 3 insists on a more rigorous view, a view based on control and fair values. Section 4. Measuring the acquired universe assets, liabilities, and their values. How do we measure what is acquired? IFRS 3 provides specific guidance here. Acquired identifiable assets are key, so are the liabilities that are assumed. These are generally measured at their fair values. This measurement happens on the acquisition date, the date when control changes hands. Fair value is an important concept. It reflects the price in an orderly transaction between willing market participants. Think of fair value like this. It is like determining the intrinsic brightness of a star, not just how it appears from Earth, affected by distance or cosmic dust. It is an objective, market-based measure. This principle applies broadly to tangible assets like buildings and machines, and to intangible assets as well, such as valuable brand names or patents, even customer relationships if they meet criteria. IFRS 3 requires their recognition if they are a present obligation and if their fair value can be measured reliably, leading to a more honest financial portrayal. Section 5. The Enigma of Goodwill, an intangible star in the financial galaxy. Now, let us discuss goodwill. It is a fascinating, somewhat enigmatic concept. What exactly is this goodwill? It arises in a business combination. It is the excess of the consideration paid, the price the acquirer pays for the business, over the net fair value of identifiable assets acquired, and of course the liabilities assumed. It is the premium paid, in essence, for something more than just the sum of parts. Goodwill represents future economic benefits. These benefits arise from other assets, assets that are not individually identified and not separately recognized in the accounts. Think of it as synergistic energy, the combined entity being greater than its individual components standing alone. Or perhaps it is the reputation built over years, the loyal customer base, the skilled workforce. These are valuable yet hard to pinpoint. Under IFRS 3, accounting for goodwill changed. Goodwill is no longer amortized systematically. Instead, it must be tested for impairment. This test must happen at least annually, ensuring goodwill on the balance sheet reflects economic reality. Section 6 IFRS 3 in action real-world constellations of business combinations. Where do we see IFRS 3 at work? Its applications are all around us, in any merger or acquisition. These events reshape our economic landscape. Consider a large technology company, a giant in its field. It acquires a smaller, innovative startup, a rising comet full of potential. IFRS 3 dictates how this acquisition is recorded. The tech giant must account for the startup's assets. These assets might include valuable patents, cutting-edge software, or unique technology, and of course, any liabilities the startup has. The difference, if the price is higher, becomes goodwill. This goodwill reflects the startup's future promise, its innovative team, its disruptive ideas. IFRS 3 ensures this is all transparently reported, so investors can see the full impact of this cosmic joining of corporate forces and understand the new combined entity better. Another example, imagine two retail chains, both familiar names on our high streets. They decide to merge their operations to create a larger, more powerful retailer. IFRS 3 provides the accounting rules. It ensures their combined financial story is told in a consistent and clear way. Section 7. The gravitational pull of IFRS 3, impact and compliance in the business cosmos. What is the overall impact of IFRS 3? Its gravitational pull is significant. On financial reporting, it brings positive change. Information becomes more transparent, more comparable between different companies, and ultimately more relevant to users. Users like investors, lenders, and analysts. They rely on financial statements to make critical economic decisions. IFRS 3 helps them do this better. The standard provides a much clearer picture of the acquirer's financial position and its performance after the acquisition by requiring assets and liabilities to be recorded at their fair values. It offers a more current economic snapshot, the treatment of goodwill, not amortizing it, but testing it for impairment instead. Also gives a more dynamic view of this important yet intangible asset. Compliance with IFRS 3 is not optional. For companies that use international financial reporting standards, it is a mandatory requirement. The global economy is increasingly interconnected. Many countries have adopted IFRS or standards closely aligned with them.